Somebody requested that I make a video about SPACs, which are special purpose acquisition vehicles that buy companies and then list them as IPOs. And I'm going to sum it up for you right now so you don't have to watch the entire video unless you're really interested. It's a big nothing burger. It's not really too interesting if you're an investor. I wouldn't recommend investing in them at all. I would tell you to stay away from them. And I'll explain in this video why I think they're so risky and why they're kind of bizarre. And then as far as the impact and what it's going to mean to you in the marketplace, if you don't buy them, it's not going to have any impact on you. So that's why I say it's a big nothing burger. You can just ignore them and be happy and make tons of money investing in other things like diversified mutual funds or solid blue chip companies or anything else that you think is a great company that you can hold on to for a long time. Now that that is out of the way, what is a SPAC? A SPAC stands for a special purpose acquisition company. It's also called a blank check company. People raise a bunch of money, it's all cash. They go public and list that company with all that cash, and then they go acquire a private company, and then that private company goes public. So for example, SoFi. SoFi is a private company. They lend to students. They do a lot of private loans. And a company went public. It has a ticker symbol of IPOE on the New York Stock Exchange. And IPOE has bought SoFi, and now SoFi will be going public. I'm sure the ticker symbol is going to change, but if you were to look at IPOE, you'd see it, and you'd be able to buy and sell shares. Next up, why are these SPACs so bad for investors? I think there's two reasons. First, when a SPAC goes and buys a company, the company that they're purchasing has to give forward guidance, or they're able to give forward guidance. In other words, they're able to tell you what they think their numbers are going to be 6 years from now, or in 2026, something like that. And that is nuts, because nobody knows what the future is going to be like, and yet these companies are projecting what their revenue and profits are going to be. That's different than an IPO. When you have an IPO like Airbnb and it goes public, there's a quiet period where all the company can talk about is actually what happened in the past, and everybody else has to figure out whether this new company that's going public is going to be a good deal or not. Why is this important? Well, if you're a SPAC and you're giving forward guidance, you're basically making up the numbers, and you can say whatever you want, and you're not liable to that. So, of course, there's going to be exaggeration. And some people might actually believe that exaggeration and then may buy the stock thinking it's a good deal, when in fact the numbers that they've put together are an exaggeration and not worth making a bet on and not worth investing in. I think the second problem with a SPAC is the way that they're structured. Once they go out and go public, a year from going public, the owners, the people that raise the initial funds, can redeem 20% of the company. And they can buy, or redemption is probably a bad word, they can sell 20% of the company's shares. And in order to sell these shares, they have to go and buy them, but they buy them at a bargain basement price. They buy them for $10, plus any accrued interest that's happened over the life of the company. And they basically buy them for $10 and then they go sell them. So imagine you're an investor, you raised $1 billion, you have your SPAC, you go buy your company, you're public, and you say this is the best company ever. You give a lot of crazy forward guidance. The share price doubles from $10 to $20. Now there's $20. You redeem all your shares to all these people that are holding these $20 shares. And unfortunately, the company in the long term may not be worth that. So the investor kind of pumped up the company only to dump it. Now, I'm not saying that all these companies are acting in a bad way or are trying to take advantage of people, but the incentives are just all off. The transparency is not there. They're able to make up these numbers or project numbers about the future. And of course, there's this big redemption option, which makes all these incentives align towards sort of pumping the stock up and then redeeming it, benefiting the owners, and then the owners walk away, or the original capital raisers walk away. And I think that's unfortunate, and I think that's why investing in these SPACs is not a good idea. So don't buy SPACs. Of course, the problem is, how do you know something's a SPAC? Because they can actually go acquire a company, you can have a ticker, you go look at it, but how do you know that they still got a year left and the capital raisers could redeem their shares and dump a bunch of stock? How do you know that could happen? Well, you're going to have to do your research and find out. SPACs have been, in the past, they weren't something you ever had to worry about, so there's so few of them. Now there are quite a few, but in total size they're really not that big. It's about 85 billion. So even if all the SPACs that were created so far, went down to zero, it wouldn't have a huge impact on the market. I mean, think about Apple and Microsoft. They're each like $2 trillion. So, 85 billion compared to these $4 trillion of these, top two companies in the S&P 500. It's a very small percentage. And that's why I said earlier, if you don't buy them and you stay away from them, it doesn't have any impact on you, and you can just ignore them. If you're sort of a student of the market or you're sort of interested in financial stuff, you may be asking the question, why are all these SPACs arising now? What's happening? Well, what's happening is, over the past, I've talked about this before, but over the past, 4 decades, 5 decades maybe, the number of publicly traded companies have been decreasing. And that's because it's so onerous to go public, and all the filing requirements and liabilities that go along with it, people have decided it just isn't worth it unless they're a super big company. In addition, companies have been able to grow and be entrepreneurs and get a lot of private funding, and that private funding has allowed them to grow without needing to tap into the public markets. And for those reasons, the number of publicly traded companies have been decreasing. I think a lot of companies would like to go public, they would like to tap the markets, but they don't want to deal with all the reporting requirements, and they don't want to deal with the compliance that they need in order to go public and go through this IPO process. So that's why SPACs offer a great deal, because companies that want to go public but don't necessarily want to deal with all the compliance issues got to kind of get around that with this reverse merger. They get around it because they don't have to go through a quiet period, they don't have to go through a banker to float their shares, then a bunch of other stuff that you have to go through. They don't have to go through as much compliance work because it's a reverse merger. It's not a company going public, right? It goes back to those transparency and reporting requirements that are different. So for companies, it's a pretty good deal. Yeah, I'd love to tap the public markets, but I didn't want to deal with doing an IPO on my own. So, hey, you're willing to buy my company and then I'm public? Sounds good. And so that's why it's interesting to entrepreneurs and small companies. But what about the other way around? Why is it interesting to folks who want to bring companies public? Well, it's interesting to them because they feel there's people that are raising cash, especially because interest rates are so low, it's easy for them to sort of create cash or get loans. And with those loans, they're like, what should we do with the money? Well, they look at these companies that are entrepreneurial companies that are growing, they're like, gosh, this company's growing so fast, much faster than I could grow my savings if I put it into a bond, or which has a negative real interest rate, or I can't put it in cash, or other things. I just don't have too many options. So why don't I try creating value by going and buying a high growth company? Then I'll get a better return on my assets. Plus, with the SPAC, they get this redemption right for 20% of the original shares at the original listing price, which is $10. So these capital raisers also get sort of a bonus for bringing these companies public with these redemption rights. If you've gotten this far, you may be wondering, well, this sounds bad. Like, why hasn't the SEC jumped in? Well, the SEC's always got to balance, right, transparency and disclosure rules against what they think is best to have a functioning liquid market. In other words, they don't want to create a bunch of rules that are just going to dry up the IPO markets and force everybody to go private. And, with the number of declining public companies over the past, 4 decades, they thought, hey, maybe we're doing things wrong here. Maybe we should be loosening things up so companies can go public. The going public in a SPAC route, they say, is twice as fast as going public in an IPO process. So if an IPO process took 2 years, going public with a SPAC might take 1 year. But the SEC has also introduced new means for people to go public, and an example is direct listings. Direct listings is when you basically just take a bunch of shares and put them on the exchange and hope that people buy them. I think this is a great way to go, but the problem is you have no idea who's going to buy them and who's not. and prices are set on the margin. So even if you have enough buyers for all your shares, if demand is low, it can really undervalue your company because it's the sort of the last people trading that really set the price for the stock. An example of a direct listing would be Roblox. They just went public with the direct listing and they did great. So I'd like to see more companies go public with direct listings. I think that's a great opportunity. It's better than going through the SPAC process. I do think, though, the SEC really hasn't got the balance right here when it comes to SPACs. The first thing I would criticize the SEC on is allowing these companies to provide forward guidance. If you have two companies that merge, and these are companies that are going concerns and they've had a public track record, then the merger of the two companies should talk about what the future is going to be like, and they should make predictions on cost savings or ability to increase prices from merging. But when you have a company that's just all cash, that's buying a company that's still in a fairly early growth stage and may not have profits, that's not really a merger anymore. It's just an acquisition. It's just a cash injection that drives it public. And in that case, I think that they should follow the same rules that other IPOs follow. And they shouldn't be able to disclose what's going to happen in the future. This weird case of these SPACs being able to give forward guidance 5 years out, I don't think is good. I don't think it's good for investors. I think there's too many incentives to over exaggerate and inflate the numbers. And finally, the third piece that I would say is that the SEC has made it too hard to go through the IPO process. It should be a lot easier. I don't know if it's the capital requirements or whether it's the reporting requirements or what it is that makes it such a hard and difficult process to go through. But finding a way that companies could go public earlier would be great. And I did want to circle back and just touch on this again. As the time of I'm recording this, the total SPAC market is about $85 billion. If you look at the Russell 5000, that's about $41 trillion, right? So, it's less than 1% of the total Russell 5000. So even if all these SPACs go away tomorrow, it would only cause like a 0.8% drop in the Russell 5000 index, which is not really that much. If SPACs continue to grow and these are seen as super risky companies, then it could cause a bigger market impact and it could have knock-on effects. People that loan or take bets might loan money to try to buy these risky SPAC companies, and if these risky SPAC companies go under, then they'll have to repay their loans. If they're going to repay their loans, then they may have to sell other equities that they have, and that just generally causes the market to go down. So that's what I mean by those knock-on effects. So I'll just repeat it again. My takeaway is stay away from SPACs and don't worry about them. It's a big nothing burger.